When will this bubble pop? I believe that we are in a stock market bubble. Now, it doesn't mean that the bull market ends next week just because I said that, but there are signs that we are in a bubble. We're going to go over those signs today, and we're also going to talk about how we might determine how far the current bull market will carry on before an eventual and if not inevitable pop happens. I always like to say we can't predict as far as precise timing, but we can prepare. My name is Keith Richards. I'm President and Chief Portfolio Manager at Valuetrend Wealth Management, and this is the Smart Money Dumb Money Show. And because you're watching, you're smart money. Now, I'd like to start off by noting that this video is kind of a complimentary video to a blog I wrote on October the 8th. I'll put a link down below, but you want to read that blog because usually in my blogs, I can cover much more detail. And in fact, I quote a couple of top money managers in the world and some insights they had in addition to what we're going to be talking about today. Whatever the case, as I mentioned at the beginning of the video, you can't predict timing. So people, when they hear me say, I believe we're in a bubble, it doesn't indicate that I know the date that the bubble will pop. And in fact, I've been in this business for 35, almost 36 years. And before that, I was just like many of you watching this video, I was trading on my own. So I've got some 40 years of trading and analytics behind me. And I can tell you that I've learned to see the signs of a bubble because I've gone through several bear markets and two major bubbles, the 2001 and 2008 bubbles. In each of these cases, there's always signs, but it still doesn't tell you the exact turning point of a market. So we're going to talk about those signs that we're looking at, and it gives us some indication as to when we should start to get more and more nervous as the bubble tops appear. And they always have certain characteristics that I'm going to talk about. So let's get started. Now, the first and probably most simplistic way of talking about markets topping is the good old trailing price to earnings ratio. Now, price to earnings ratio is an overused ratio because growth has increased over the last 20 years with the advancement of technology. So we have to accept that PE ratios from, let's say, before 1990 and leading up from 1990 to current times, they've changed. They're much higher and deservedly so because growth rates are higher. So to start off with the most simplistic of measurements on whether a market is overbought or overvalued, I should say, or undervalued, we can look at the trailing, not forward, but trailing price to earnings ratio. That is the actual earnings in a given year against the current price. So if we look at the era from literally 1880 out until about 1990, we had 100 plus years where the markets would find bottom somewhere in the 10 area and then would be a good opportunity to start buying stocks again. And when they were getting much over 20, we would have a point of overvaluations and markets would eventually decline. And the declining of the PE ratio is indicating that prices were declining on the market at that time. So if we look at the current era, things have changed. Why? Because of technology. The technology stocks that emerged through the 1990s and into current years have been far greater in growth than during the industrial era, I should say. The earnings growth coming out of tech stocks is exponential compared to what we used to see before 1990. So we now see PE ratios in the 20 to 30 range, where 30's getting expensive and 20's getting cheap. Interesting, because 20 used to be the cheap area or the expensive area. So where are we right now? Well, if we zoom in a little bit, We're at 31 on the trailing PE ratio. You can see in the past the ratio's gotten higher, but we're always taking our chances the more it goes over 30. So my suggestion to you is that keep an eye on PE ratios because, for example, during the COVID crash, we had hit just around 35 before the market started contracting. We don't know how high it'll go, but we can be prepared to know that it can't go an awful lot higher than it is now. The next thing I want you guys to take a look at is a long-term chart of the S&P 500, and this goes back to 1928-29, so it takes into account the market meltdown in 29 and the subsequent recovery. But what you'll see here is I've drawn what's called a trend channel, and it tries to outline where the troughs and the peaks line up in a long-term trend. So what we can see is that markets tend to, when they reach the top of that trend channel, find a reason to contract. And this happened in the 30s, this happened in the 70s, this happened in 2000, and again, it happened in 2008. The market likes to regress negatively back to the middle or bottom of this channel when it gets to the top of the channel. Where are we right now? Well, we've seen one touch back in 2020 and a contraction, and we're right back up again at the top of the trend channel. So because it's actually kind of hung out at the top of the trend channel for so long, my thoughts are that we're going to see at some point a major contraction to bring it down to at least the middle of that trend channel. It's just law of averages, regression to the mean, whatever statistical language you want to use. Things don't stay at the high end of their data points forever. Now, you guys may know I've written a book on contrarian investing. It's called Smart Money, Dumb Money. That's what this show is named after. And I tend to follow a lot of sentiment indicators. And I sometimes show you different sentiment indicators on this show. But today I want to talk about two of the big daddies in the sentiment indicator world. They're really macro indicators. They can be used for short-term timing, but really I like looking at these for the big picture and to discover where we are within an overbought or oversold or fairly valued market. So we're going to start off with the put to call ratio. And both of these indicators, by the way, I'm going to show you revolve around options. So what this ratio shows us is that if too many people, quote unquote, too many people are buying puts versus calls, so the ratio gets to 1.25, 1.25 puts for every call that's being traded, we have a high fear market. Why? Because puts are bought when you are bearish and fearful on the market. Well, the opposite is true when the put to call ratio is at 0.75, meaning there's about 0.75 of puts being traded for every one call. Then we have levels of complacency. This all comes down to the desire of individuals to either hedge or go long with an optimistic attitude, depending on whether they're leaning towards puts or calls. So we can track the absolute levels that I've done here, and you can see when you get spikes, they quickly reverse. When you get spikes to the lower end, they quickly reverse up. But I want to look at the overall trends, because this is what we're looking at when we're looking at a bear market or a bull market. We're trying to figure out the longer term picture insofar as where is the sentiment going. So when we look at the general trend of the put to call ratio, we can see that, for example, here's 2008, which was the beginning of the great market meltdown between 2008 and early 2009. You can see that fear was increasing. Well, it makes sense. The market fell 50% between early 08 to March of 09. Well, you can see that more and more people were buying puts and almost nobody was buying calls. Okay, that reached a peak level, and then smart money stepped in, and you started seeing calls being bought, and people were letting their puts expire, etc., because the damage had already been done. On and on, you'll see this pattern has repeated. And you can see, you just look for the white spaces and the dark spaces, and you can see where the overall trends of the put to call ratio is going. So lots of white space in here. You saw a contraction after the 2020 fear, COVID, and then a bottom. And as 2022 bear market began just a few years ago, fear began to pick up, lots of white space down here. Lots of people were buying puts through 2022. And of course, right at the peak, they would be, buying their puts at the exact point where they should be buying calls or buying stocks. So the trend of late has been, to lots of dark down here, meaning a lot of complacency. People are buying much more calls than they are puts because they feel there's no reason to hedge their portfolios. And that is a sign of complacency. And that is a typical sign leading into every bear market that I have been involved in since my career, including the 2 bubbles. Hey guys, sorry for interrupting the video, but I needed you to know that this coming Monday, October 20th, I'm on BNN television again. It's at 12 noon Eastern Standard Time, and this is the one time you can ask me questions about stocks. And if you mention that you're a subscriber to the videos or my blogs, I tell the producers to push you guys as best they can to the front of the line for questions. So be sure to tune in, and we'll answer your questions on stocks and technical analysis. See you then. So the next sentiment indicator we're going to talk about is the VIX. Many of you guys are aware of what the VIX is, the volatility index. It measures the premium of options. You'll understand that if individual options writers of puts or calls are expecting more volatility, in other words, more movement, they want more premium. That makes sense. So when are premiums low? Well, when there's not a lot of volatility, because the option writers don't demand more premium because there's less volatility. This tends to show that the market in general, when premiums are low, we see the market is complacent during those periods. And you can see during the 1990s, which was much of my early career, complacency was setting in. Why? Because the market did nothing but go up during the 90s, and I remember those days very well. Well, what happens, of course, is eventually something bad happens, like, say, 2000, where the market peaks out, and you'll see that volatility starts picking up. Takes a little while for the market to accept that the volatility is over. So when we look at the period between 2001 and 2004, volatility was very high, and options writers were demanding premium. But it also showed that there was too much pessimism out there. So sure enough, people started buying stocks and volatility fell. As more and more investors go back into the market after their scare from 2001, they were buying stocks again. Complacency set in until 2008. I'll zoom in a little bit. You can see these numbers, 2008. So what happened is complacency set in. Premiums were not high in the market, and on the VIX, I should say, and sure enough, look what happened. Along came the market crash, and the VIX went to the moon. In fact, it's never been higher than 2008. Well, the pattern repeats over and over, and we've just entered a period, an early period, I will say, of complacency. One of the things I like doing is, just like with the put to call ratio we looked at, is look for the general trend of VIX volatility and option premium writing, and you can see the trend has been towards lower and lower volatility. Complacency, without a doubt, is settling into the market. We're not super over complacent like we were in just before some of the extremes and extreme market sell-offs, but we're getting there, and that's why I wanted to bring this chart to your attention. So the next thing I'm going to show you is a very simplified drawing. You guys have seen this a million times before. I've used this in a couple of my books. Basically, it tells us that markets move from periods of bullish behavior and eventual euphoria right at the top, to bearish behavior where people get more and more pessimistic and move into a point of capitulation, panic, and despair at the bottom, and it repeats itself over and over. So the reason I bring this up, you guys are probably aware of that drawing, you've probably seen it before, but I bring it up because we need to know where we are in that cycle. Well, there is a tool that we can use to try to determine what part of the cycle we're in. I'm going to talk about that next. Now, what I want to talk about a little bit is what's called Elliott Wave Theory, and just right off the top, I am not an Elliottian. I am not an expert on Elliott Wave Theory. However, as any good technical analyst, we try to understand the basic principles behind any of the observations of the market, and Elliott Wave does a pretty good job of giving us a basic picture without getting into all the Fibonacci retracements and the ABC zigzag movements and all that stuff. I'm just interested in knowing the characteristics of how the market might work, and Elliott Wave does a good job. So Elliott said that the market moves in 5 waves in the major wave, which is usually referred to as a bull market. So 5 waves up and 3 waves down. And each one of those waves has a characteristic. If we look at this diagram here, you can see that wave 1 is generally entered only by the pros and very sophisticated investors. And usually in wave 2, that's a counter wave, the average investor is still saying, I think that's a false rally. So they are selling. We get the biggest wave, or the biggest move on any market, is wave 3. And it's usually where the public starts entering various mutual funds, institutions. There's a counter wave. And then finally, in the 5th wave, it's where the dumbest money enters, because it's an enthusiastic, rabid, everything is just going great kind of atmosphere. It's party, baby, party. The market's going to keep going forever. And as the market starts to pull back, generally speaking, it's the pros and savvy investors who start shorting, who start selling, things like that. There's often a counter wave because you've got those retail investors in the background who believe that that's just a correction. That's not a bear market. I'm going to buy. It's a buying opportunity. And of course, then the final washout comes in. And finally, the general public starts selling. So that's the principle of Elliott Wave. I've put together this quick diagram here. I won't go into detail, but wave 1 is the smart money. Wave 2 is the crowd saying that was a false head fake. I'm not going to buy in. Wave 3 is where the real crowd starts to buy. There's a weak corrective period where the crowd does buy the dip, and correctly buying at that point. And then in wave 5, the dumb money gets extremely bullish. It's typically a concentrated market, such as AI. It's typically a very tight market, and I'll show you what I mean by that in a minute. And then finally, corrective wave, it's the smart money moving first to sell off. The counter trade is the crowd, the dumb money, who are used to the up market. They saw it fall and go, well, I've missed out on some of the dips in the past. I'm buying this one. They buy, and then they get their head handed to them on a platter because the smart money sells into that counter wave, and eventually the crowd capitulates right at the bottom. So if I were to apply all that fun stuff to a S&P chart, and remember, I'm not using Fibonacci ratios. I know all about them, but I'm not going to talk about it because actually I don't think they're that accurate at measuring where things are going to go anyways. But having said that, I don't want to get that deep in this video. So basically what we're looking at here is the 2022 market bear. It peaked in 22 and ended up making a bottom somewhere around the end of 2022. We put in kind of a base and a breakout, and the market started moving up. Well, if we take that first move up before the first major counter trend movement down, you could call that wave 1. There's our counter trend down, okay? And then wave 3, see how big it was? It moved for a very long period of time. It moved basically from the middle of 2023 after that first correction to early 25. That's the longest wave so far in this sequence. Then we had the counter trend movement that was brought on by Liberation Day. But remember, any correction is always when a market's a bit overbought and it looks for a reason to sell off. And I cover that in my blog that I'm going to talk about in a minute. But basically, the market did a counter trend, wave 4, around April of 25. And since then, this is important now, why I believe we're in wave 5, although not necessarily saying that it's going to end next week or anything, but take a look at how tight this is. You'll notice that there's hardly any volatility. The bars are tiny. There's no zigzagging. If you look at this, we had many higher highs and higher lows, lots of movement on the market. Here, there was lots of movement. Here, there's basically no movement there. This is very tight. In fact, even at the beginning of wave 3, we had a very tight market and then ended up with a correction. The difference between right now and say the beginning of wave 3 is back then we didn't have high levels of complacency as seen on the VIX and the put to call ratio like we have now. We didn't have overvalued markets with the PE of 31. We didn't have low breadth and all the factors that I've talked about many times in my blogs and videos. So this is, to me, an obvious wave 5. It's so tight, no volatility. Markets can't survive forever with low volatility. And if you think they can, you're fooling yourself. So these are the signs we're looking at. How long can it go? I'll talk about that next. So how do we know when the bubble will burst? Well, as I said at the beginning of the video, we can't predict. We can only prepare. We can look at the signs and know where we are in the market. In my opinion, based on everything I'm looking at and 40 years of trading on the market through multiple bear markets and 2 bubbles, the 01 and 08, I've been there and done that. And I am seeing the signs of a bubble. It doesn't mean I know when this bubble will pop. I don't know. So markets are, I like to say, a little bit like a balloon. You blow the balloon up, it gets bigger and bigger and bigger and tighter, and then somebody comes along with a pin and it bursts. Or maybe they walk by and they're wearing cufflinks like I do, and the cufflink scratches the balloon and the balloon pops. People will blame, the investors will blame that bubble market, that balloon market bursting on the guy with the cufflinks or the person with the pin or the belt buckle that scratched it or whatever. Yes, the pin was the cause of the breakage, but remember, the balloon was too tight to begin with. Perhaps the balloon would have survived my pointy cufflink had it been half as inflated as it is now. So what happens is the market gets ripe for correction. I believe the market is ripe for correction. What's going to be the catalyst? I don't know. Maybe an escalation in one of the multiple wars that seem to be going on right now. Maybe some more Trump tariff stuff. I don't know what's going to burst it. I do know we're set for a bubble. We are in a bubble. We're set for a burst. It may not happen for a year. It may not happen for who knows how long. But it's going to happen, and I can say that based on witnessing 2 of them live in a seat behind a computer screen trading stocks. And I can tell you just from classic bear markets, this happens every single time. So hope that helps, and we'll see you next week, hopefully with more encouraging news. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel, and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at Valuetrend. And by the way, I don't just talk the talk, I walk the walk. I have been a portfolio manager for 35 years. And in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk spam and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a longtime portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.